And Elliott Waves, I've heard kind of can be found in nature's blueprint. They're rooted in the Fibonacci sequence, which I came to understand as a young architect back in the late 80s, early 90s.
But Elliott Waves express themselves as a measure of mass psychology. So the broader the index, the broader the market, the more volume, the more interest, the better the Elliott Waves express themselves.
The greater the mass and the more emotional the market is, the prettier the waves tend to be. Let's put it that way.
So do most people buy in at the top of the fifth wave, the human emotion part, the greed, the FOMO?
If you could measure it, I think you would find there is more money invested by more people at the very top than at any other time, and they have the greatest expectation for it to do better than ever. It's just weird, but that's how it goes.
But it makes sense, I don't want to miss out. Don't leave me out, and you already missed out on the value. Gold is up 30% this year, and it's completely and totally ignored. It's outpaced the S&P. It's averaged 9.9% per year for the past 25 years. It's completely and totally ignored. It's the tortoise, not the hare.
I think the biggest moves yet to come probably are going to be in silver relative to gold, but gold and silver together are going to go higher.
Well, it's a good job we launched silver on Glint last week, isn't it?
Yes, it is. Long overdue. I'm glad it was done. I think it'll be a home run.
Hi, Andy. How you doing?
Jay, I'm doing good, brother. How about yourself?
I'm good. Yeah, everyone's gearing up for Christmas here at Glint. We all seem to be accelerating and doing more and more, as everybody else around me seems to be doing less and less.
Yeah, well, that's the curse of being an entrepreneur and founding a business. It's a blessing and it's a curse. But I'm very excited to learn from the gentleman that we have coming on today. I've always been, I guess you could say, fascinated from afar with Elliott Wave. And I think there's so much to the theory that markets are driven by investor psychology and fear and greed. And although I don't know much about it, I understand the basic premise, and I'm really looking forward to learning from these guys. Should be fun.
Yeah, well, for everybody, if you've read the description of what we're talking about today, we're talking basically about how kind of fractals, mathematics, patterns, that affect our entire lives wherever we look, whether it's in nature, the economy, actually can be used to help us understand markets. So I'm very pleased to announce today we've got Elliott Wave on the show. Stephen Hochberg is a leading expert at Elliott Wave forecasting. And also with us, we have his colleague, Peter Kendall, market analyst and editor at EWI since 1992. Hi, guys. Welcome to the show.
Hello.
Thanks for having us.
So Stephen, maybe just to start with yourself, you've been involved with Elliott Wave Financial for a while now. Can you just give us a little bit of experience about your background? Let's get to know you a little bit. Like, where does it all start for you? And then we'll go on to Peter.
Sure. I was always interested in markets growing up. When I got out of college, I went to work for a major Wall Street firm in 1984. I started on the retail side as a broker, and I was probably the world's worst broker there was anywhere in the United States at the time. But I stuck with it for a while, and while I was there was this newsletter that was coming across our desk about this guy named Robert Prechter, who had just won the United States Trading Championship with a 444% return over a very short period of time. And I was like, I need to find out what this guy is doing because he's having success. And that led me to studying Elliott Wave analysis. I went back to graduate school, got my graduate degree. And when I got out, I packed my car up from Massachusetts and drove down to Bob's headquarters. And I've been with him ever since, talking markets and studying Elliott Waves and talking to our subscribers and anybody else who would like to do that.
He know you were coming down, Steve?
Yeah, he did know I was coming down.
You didn't just force your way in and say, I'm here?
Yeah, actually, it kind of was like that a little bit because there was a question about an opening at the firm. And when I got down there, they were like, well, and then all of a sudden everything kind of opened up and I got my own office and we went from there.
Very cool.
And Peter, what's your story?
Let's see. I go back to almost exactly the same year, 1984. I was a reporter. I worked for a publication called the National OTC Stock Journal. This will become relevant, it turns out, because it was a highly speculative pocket of penny stock speculation. And actually, it had already seen its best day in that time. In about 1983, they had a penny stock mania. But while I was there, they had a tech mania, mini tech mania, let's call it, the mania of 83, 4. And I just learned a lot about the speculative area of the market. So that's coming into play now. I met Bob at that point. He had ideas about the market which meshed with my own. And it took a long time. It took a few years, but by 92, I was working with him in Gainesville, Georgia, and I've been there metaphorically ever since. I don't work in the office anymore since COVID, but I get back there frequently. And so I guess that's the basic story.
Great. Well, listen. Are you enjoying the show? A quick reminder then to hit the subscribe button so you can be kept up to date about future episodes. Now, back to the show. Well, Elliott Waves, I've heard kind of can be found in nature's blueprint. They're rooted in the Fibonacci sequence, which I came to understand as a young architect back in the late 80s, early 90s, which was fascinated me that, patterns could be found in nature that repeated themselves again and again and again. Mathematical formulas for, what was good design. Architects across the world had found it, sacred geometry and things like that, whether it's from Islamic to Greek architecture. Of course, they're found in mathematical spirals, are found in sunflowers, in our galaxies, where of course, gold is created when two neutrons collide. So I'm always interested in what's going on in the galaxies, in seashells. But of course, you're using them, these mathematical patterns to govern, look at how they govern market trends and stuff. So where does it all begin? Our audience wants to know. They're interested and they're intrigued. It rooted in basically the need to be able to protect themselves as we go forward in what effectively is a polycrisis at the moment. Where would you over to you really to kind of explain where this all starts and explain it in basic terms?
Well, I would just interject, go back a little bit to the Fibonacci spiral and the ratio and the numbers. And you're saying that as an architect, you learned about it because it was reputedly the most natural composition for a structure. It was the most efficient. It tends to be in nature. It tends to be the most efficient way of building something. So the point I'm trying to get at is Elliott didn't know what the Fibonacci ratio was. He looked at stock prices exclusively. He looked at the empirical evidence as provided to him by the market itself, dating back, I would think maybe 50 years or so, just stock prices, and that was all he had. He developed his theory. It's very precise in how it measures things, and it turns out it resembles the Fibonacci ratio and sequence. The waves are actually the Fibonacci numbers themselves. So he didn't know what it was. He had to be told what it was after he basically rediscovered it. So I think that's a fascinating aspect of it.
And have you applied working backwards that way with other markets to see the accuracy in retrospect of many of the markets that you've analyzed? In other words, have you ever looked back just to test, like you're explaining right here?
Yeah, I mean, we're always looking back. And the reason we're always looking back is because human nature and human psychology doesn't change. It's always been the same. And so the patterns that we see today that we're trying to help forecast for the future, we look back and see those same patterns years and years and years ago. As long as we have stock market data or any market that's freely traded, it's going to express in some way an Elliott wave. And it's just Nelson. It's Elliott's discovery, Ralph Nelson Elliott's discovery, that crowd behavior trends and reverses in predictable ways, in these patterns that they trace out, and these patterns link together, as you've been talking about, to form this hierarchical fractal. So that the same patterns you're seeing at a very small degree, you see at an intermediate degree, a larger degree, and a larger time frame. So it's these patterns that we're looking at that help us give us an orientation about what's happening in the future. And it wasn't that long ago that the idea that market movements that are patterned, it was pretty controversial actually. And recent science discoveries have shown that pattern formation is really a fundamental characteristic of complex systems, and that certainly includes the financial markets.
So does this relate to the kind of thing that I hear about people analyzing the market, they're chartists and stuff, where they're looking at teacup handles and all these kinds of different things? Is it in the same sphere of analysis or not?
Yeah, but Elliott wave analysis is actually the highest degree of what you're talking about, which is basic technical analysis, because it's pattern recognition. And so a technician is looking for certain intra-market devices to help forecast the future, like momentum. How fast is a move going to the upside or the downside? What type of sentiment is surrounding it? And what the Elliott Wave analyst does is he takes all that information, but he inputs it into the highest degree of analysis you can get, which is pattern recognition. So at its utmost, we're looking at the patterns because they imply something about the future.
Jason, you'll ask us certain questions, and we won't be able to answer them if they're like fundamental in nature, if they're about earnings and these types of things. But we're in the branch of market analysis called technical analysis, and if you ask us certain questions, we'll just be staring blankly at you. But when you ask us, about where you think the markets are going, we usually have a pretty strong opinion about that.
Well,
has
great.
there ever been a time where Elliott Wave didn't work, or is the human emotion pattern and these patterns that you've seen throughout all time, are they that predictable and that ingrained in nature and in human beings that, as far as you can tell, it's provided a good guidepost as far back as you can see?
Yeah. When we were talking before about, do you look back? We always look back and we always find the wave pattern. Unfortunately, many times, maybe most of the time, we don't know exactly where it's going to go in real time. So we have to continually monitor and see where it went and then adjust, say we had the pattern wrong. We're looking at this instead of that.
No, I like that.
Yeah. I mean, the patterns are always there. They're ingrained, but our fallacy is that we're human, and sometimes we can't recognize them in real time as we should. So the patterns are there. It's just up to us to figure them out.
So are you, and I don't mean, Jason, to I'm just fascinated with this and its predictive powers. What's the role of AI in all of this? Is AI being brought in to assist in your applying of Elliott Wave to what's going on in the markets?
Well, we actually have a computer program. It's not AI specific, but it's the only one that we're aware of that will generate Elliott waves and plot them on a chart. It's called our E-Wave system, using the rules and guidelines of Elliott itself. And there's certain rules and guidelines that we have to follow when we're putting together our analysis of what's happening in the market. But we're human, and we can. And sometimes it's impossible for us to follow every single degree in every market in every pattern. And this computer program that we have that we run internally helps us do that. And so it's kind of our way of getting into the AI space, but we don't use AI specifically to plot the waves. For that, it's just rules and guidelines, and then our interpretation of them.
Presumably, it's a kind of, it's also dependent on the data as well. The surfer who's on his surfboard, he's counting the waves, he's feeling the vibe, he's like been out there for years, he knows what kind of, he starts to recognize patterns in waves, but he hasn't got the satellite view either, which is telling him that there's just been a landslide across in Japan that's going to, mean that it's going to hit his shore in about 4 hours time. So presumably it's all about the analysis is only as good as the data as well that goes into it. Is that right?
I would say that's exactly right. And as far as I know it's not our area. It's called E-Waves, and it's been around a long time. And I'm sure that they will incorporate whatever they need to make it, to improve it as best it can in given the technology. I'm sure they're going to keep with the times, as it were.
The trends that you see in Elliott wave analysis are endogenously derived. It means that outside stimuli and forces aren't creating the waves. The waves are being created by humans in their interaction, their social interaction, as they get more pessimistic and more optimistic. So there might be like a hurricane that infects some crop price or whatever, but the waves are the waves. They're and the trends are endogenously generated, meaning that as people get more optimistic, they get more optimistic in a patterned way internally relative to any outside stimuli. And then the same thing is when they get more pessimistic, they do it internally. And the theory that Bob Prechter developed is called socionomics, where social the mood, crowd psychology determines the tenor of social events. So that I'll give you an example. Like most people say that recessions cause business people to be cautious. But the way we look at it, it's that cautious businessmen cause recessions. So we turn the causality around. And once you kind of have that notion that the right causality, it helps you analyze and look at things that are going on. People will say a rising stock market makes people very optimistic. But what we would say is optimistic people make the stock market rise. So that's kind of how we approach our analysis.
Okay. Can I go back now and I'll give you a transition here, which is going back to AI and how it fits into the wave principle in another way, and how we say how we interpret the current boom in AI, which is that if you go back to the one chart that was shown that shows the basic pattern, there you go. Now, over the course of a bull market, you have certain results, which creativity is the driving force, but innovation is the result. People become more creative in as the waves progress. You see that we have a first wave up, followed by a second wave down, which is, not expected, and people are kind of confused, but it should not retrace below the starting point of wave one. So you're on your way. In wave three, that's the biggest wave. Usually the largest breadth in terms of the stock, how many stocks are going up versus down. The fourth wave is surprising disappointment. And then in wave five, which is where it's trying to get to, which is where the creativity and the innovation is most bountiful. So you end up at the very end of that fifth wave, which this basic pattern takes place over different degrees of trend. So one fifth wave ended in 1835, another one ended in 1929, and one is ending now. And what you get at the end of these periods is a flourishing of technology and a belief in innovation. In 1835, it was electricity, the railroad, the telegraph. In 1929, it was automobiles, the radio, TV. TV hadn't even come along, but they priced it all in terms of RCA stock. And of course, it went down 90%. And then in the 60s, it returned to where it was in 1929. But, everybody just got carried away, let's say. And we see it now with a thing called artificial intelligence. In 2000, we saw it with the internet, where it was blossoming and was the future. But it doesn't mean you can price it all in all at once, which is what people do at the end of a fifth wave. And that's where we are now with AI. But it doesn't mean we should buy up all the companies that do AI and spend and overpay for each one. That's just what we do at the top.
So do most people buy in at the top of the fifth wave, the human emotion part, the greed, the FOMO?
I don't know if you can measure it, but if you could measure it, I think you would find there is more money invested by more people at the very top than at any other time, and they have the greatest expectation for it to do better than ever. It's just weird, but that's how it goes.
But it makes sense. I don't want to miss out. Don't leave me out. And you already missed out on the value.
Yeah.
And so you're talking there about history spanning, hundreds of years. Presumably you can take this back through civilizations.
But I would say we take it back 200 years to the start of the Republic.
And then you can apply it to markets. Markets are varied. We have global markets, we have regional markets, we have, local stock exchanges. We have individual companies within those. How does it work with that?
Well, the patterns that we analyze are best seen on freely traded, widely viewed markets. They work a little bit less on individual companies. They do work. You do see some patterns there, but Elliott Waves express themselves as a measure of mass psychology. So the broader the index, the broader the market, the more volume, the more interest, the better the Elliott Waves express themselves.
Yeah, we find that the greater the mass and the more emotional the market is, the prettier the waves tend to be. Let's put it that way.
And those patterns that you were showing, I suppose, if you get to the end of that cycle, it starts again, isn't it? Or more a case of if you zoom out, you see the pattern all over again at a different stage, and you realize that was just a pattern down at that scale. As you zoom back, just like a fractal, you see a fractal, and then you zoom out, and even though you've zoomed out, you see the pattern again, and then you zoom out further, and you see the pattern again. So it's kind of history repeating. It's not really a kind of linear thing, is it? Well, it's kind of linear, but it's also fractalized. If anybody ever looks at, just search for the word fractals in any videos, those are videos where you zoom out from a fractal. They're pretty psychedelic, but they really show this effect where you see the pattern again and again and again, because it doesn't mean that 5 is the end of AI, does it? Or the end of technology. There's going to be a whole set of new things. As you said, you can't price things in. So these patterns can be found everywhere in nature and markets, as we've discussed, in the Fibonacci sequence, in architecture and flowers, and in stock markets and commodity prices. Where's your real interest? Where's your sweet spot?
Right.
In terms of the application of this,
our sweet spot is the stock market, and what's it going to do in going forward, using the past to generate proper expectations about the future.
We start with the stock market simply because it's the one we have the most amount of data going back the farthest on, minute by minute data on stocks. But again, any freely traded market that has a lot of volume and interest. Right now, one of the clearest patterns that we've been seeing for a bit now is in gold. And it's something that you're interested in keenly, but we've been following gold for a long time. And that market right now has just clear Elliott Waves that they're tracing out. We've been able to make some really good forecasts over the past couple of years based on it. And so, again, we're just trying to apply that basic psychology that courses through all freely traded markets. And whenever we see a clear pattern, we're there to talk about it.
We find that we're in a overvalued and overappreciated market. I think that one of the key charts we showed in, I guess it was in November, we showed it's Warren Buffett's favorite indicator is the Wilshire 5000 divided by the stock market capitalization. And what we got, stock market is 2 times the GDP, which is obviously the highest on record. Some people would say that was enough, but of course that's just ancillary to what our analysis, which is based on the wave principle and the rise up to the present point in time, which is a 5-wave pattern on different scales, which means rising from 2009, we find a 5-wave pattern inside of a larger 5-wave pattern from 1982, and then all the way back to 1932, we find an even larger Elliott wave in the stock market. So based on this series of fractal patterns, our suggestion that the market is topping out here.
You're not the only one. I see that Ray pulled up there a chart from to do with Warren Buffett's website. I think he's never before been sat on so many dollar bills. His amazing conglomerate Berkshire Hathaway currently holds $325 billion in cash or cash equivalent. So he's aligned with you. Maybe he's using your Elliott Wave analysis to also come to the same conclusion.
Yeah, and we also have cited recent issues. Insider sales have been high, as well as different other indicators of what the insiders are doing suggest that they're not too interested in holding shares at this time either. Buffett, of course, has a lot of shares. It's just he's not interested in adding more right now and is actually subtracting.
The point I'd like to make here is one of the things that we look at it at the end of a fifth wave or toward the end of a fifth wave is we're looking at psychology, which is the most important aspect of our analysis. We have our waves, and we want to know what we're seeing in terms of our indicators are either confirming or refuting what we're seeing in our interpretation of the wave structure. And one of the things we're seeing right now is just this manic movement into speculation that has elements of 1929, has elements of 1973, the year 2000, 2007, all great stock peaks throughout the last century. And we're seeing a lot of that rolled up into what not only the pattern is showing, but our indicators. We're having a surge again in meme stocks. We're seeing Bitcoin rally past the stratosphere. And I think I sent over a chart showing just the close correlation between the movement in Bitcoin and the movement in the stock market. It's not exact, it's not one for one, but they tend to trend in reverse together. So Bitcoin is a manifestation of the type of speculation, the movement in Bitcoin that we're seeing now. We got credit spreads between junk bonds and treasuries that are the tightest they've been in decades. We see money pouring into leveraged exchange traded funds. I think last I looked, there was $11 going into long leverage exchange traded funds versus every $1 that went into a short leverage exchange traded fund. So that 11-1 ratio, I think, was a multi-year high. We just saw a consumer sentiment survey come out where a record 56.4% expect equities to be higher in the coming year. That was by far a record going back to the start of the data. Pete mentioned the Buffett indicator. But there's other things like U.S. households, for example. I think the percentage of stocks that they hold in their portfolio relative to all their financial assets is about 42% now, and that's also another record. So when we flip through, chart after chart after chart and indicator after indicator after indicator, they all seem to be lining up and coming into this culmination right now at the end of this fifth wave. It gives us a lot of confidence of where we are within the development of the Elliott Wave pattern.
I wanted to go back to the leverage situation and in a particular chart, which is the RIDEX leverage bull bear fund, which ratio, which is showed it's basically, if it's 2, then there's twice as much money in bull funds as there are in bear funds. They have both. And just so interesting to me, when we ran our latest issue, it was 78 times as much in the bear funds or bull funds as in the bear funds in RIDEX. And I looked at it yesterday and it had fallen to like 20 times. The very next day, this was December 4th, was 78, then it was 20, and now it's 78 again. Like I said, I've been watching the speculative end of the market and trying to understand it and what it's trying to represent to us for a long time. And I don't remember anything quite like that, where they're so bullish. And then there's this manic bear moment and now bullish again. It's just, it's what they used to call over trading in the jargon of the mania scholars, which would be like John Kenneth Galbraith and Kindlinger. And they would study manias and they call it over trading. And I think it when you see it, and I think that's it.
And for some of our viewers who are maybe not quite as financially literate, can you just go over what you were talking about there with the bonds? Just in plain language, if you explain it to a sixth former.
Okay. The RIDEX is a fund group that has both long being getting into the market, buying the market, versus short. And so that's all the people that don't like the market and are trying to find ways to make money when it goes down. And as a matter of fact, the RIDEX funds was started as a bear fund in the 1990s. So it has a long history of, like at the top in 2000, it was like 3 times as many bulls as bears. And that was a lot. And at the time, and it was at that point that the market reversed. That was extreme. And now we have 78 times as many people in the Ridex bull shares as in the Ridex bear fund. So what you have is an extreme situation. And I was simply saying that it had gone down a lot and then went back up again. The 78 is not the highest. The highest was in 2021, but it was only a couple points higher.
Are you speaking just treasuries? Are you speaking just of treasuries at the moment?
No, it was stocks.
Stocks. Okay, I thought you were speaking treasuries. My bad.
I sent over a chart the other day. I'm not sure we have it, that we ran in our latest issue, our December issue of the Elliott Waves Financial Forecast, where we showed the net position in small traders who were investing in the futures of the S&P 500, the Dow, and the NASDAQ 100. And these, we call this small spec position. And the money just has been surging in. It's up to $100 billion, which was, I think it's over 135% more than it was at the prior peak. So when you look at these charts and you just see this money flowing into the market particularly from the retail sector, which is usually caught in large wrong way bets at major turning points. Again, it's confirming what we're seeing in our interpretation of the Elliott wave structure, which is that we're in a fifth wave. That fifth wave is nearing an end, and we're seeing all the classic signs of just manic participation to suggest that when this fifth wave does end, we're going to go into a pretty big bear market.
Interesting. Just when everyone is excited to get in because of the Trump euphoria. That's a scary thought. What could happen?
Yeah. The key word there is euphoria. Euphoria shows up at the end of a fifth wave, and we're certainly seeing euphoric action by investors at this point. And again, it just speaks to where we are within the structure. And I think we're nearing the end of this fifth wave. And when the fifth wave's over, that's it. I mean, it's done. The pattern's over, and now we go into a different pattern, which will be a bear market, an ABC correction, as we call it. But it's going to be a very deep and long correction.
And of course, what happens then is that everyone moves from the exuberance around being risk on and investing in everything and massive confidence to suddenly the bubble bursting, and then this rush to safe haven assets, or the rush from risk on to risk off.
Right.
We've seen it. We talked about at the beginning. Risk on is this investment in speculation in stock markets, in companies, and what they can do. Risk off is into things like gold, and there we have Powell, just I think within the last couple of days, the last 48 hours, the chairman of the Federal Reserve trying to compare Bitcoin to gold. And what are your thoughts on that?
I don't know about that. I'm sorry.
Yeah, he said that it doesn't compete with the dollar; it competes with gold, which is kind of interesting. Yet the central banks are the ones buying all of the gold. And one thing that I think is interesting that you guys may want to do is plot on a chart Bitcoin alongside the 10-year Treasury, because you see now the stable coins that are the primary trading partners with Bitcoin on called USDT, which is Tether USDC. These dollar-based stable coins are now primarily invested 80 to 90% in US Treasuries. So as Bitcoin has gone up, the yield on the 10-year Treasury has gone down from 4.7 to under 4.2. And I would think there's a direct correlation there. And so it would be interesting to see if the wave pattern is similar in both the Treasury market and in Bitcoin.
Well, we know it's very similar in the stock market in Bitcoin. In fact, they trend. It's not one and specific, this week and that week, but they trend in reverse together. And I think what they're showing is the basic investor psychology, the manic speculation, that when people are speculating in stocks, they're going to speculate in Bitcoin also. And we've been able to make some pretty good forecasts on Bitcoin just based on the pattern in the stock market and when we think the market's going to reverse. But Bitcoin as a store of value, which gold is real money, it's simply not there. I mean, because you've had this these tremendous drawdowns in Bitcoin since it started. I think that you had like back in 2011, there was like a 94 or 91% drawdown in a matter of 23 weeks. And then you had a huge 80% drawdown in 2015. You had an 83% drawdown in 2017 and 18. You had a 75% drawdown in 2021. So if you're going to have a store of value, you can't have the volatility that you have in a Bitcoin. Bitcoin right now is just pure speculation, and we come at it not that we don't come at it as an anti-cryptocurrency outfit. We actually like the idea of cryptocurrencies and think that there's a place for them in the future. But it's not going to be Bitcoin because its own blockchain makes it unavailable as a medium of exchange. You just can't transact in Bitcoin like you can in your product Glint, for example. I mean, it just makes it so much easier to transaction in gold. And so I don't think Bitcoin is the answer. I don't think Bitcoin's going to be the answer. It might be some different cryptocurrency that we haven't even thought about, that hasn't been invented yet. And it's coming down the pike, but Bitcoin right now is just pure speculation.
Yeah. Well, you're not saying anything
I think you have a
that
chart of
Andy-
Bitcoin. There's a longer term chart of Bitcoin that kind of describes what Steve was saying. Can you show it?
Yeah.
There we go.
So what have we got here, Steve? Can you, because it's like, our screens aren't necessarily big. Can you just describe the data first, the top chart, the bottom chart?
Okay. Yeah, actually, the top chart is the Dow Jones Industrial Average from about 2000 to the present. It's got some Elliott Wave labels on it, how we interpret the pattern. And the bottom chart is Bitcoin since its inception all the way to the present also. And we've just overlaid one on top of the other. And you can see the similarities. It's not point for point, and there's some lag and lead times, but they tend to trend and reverse together. And so when people are speculating in the stock market, they're also speculating in Bitcoin. And when the stock market goes down and starts into a correction, that's when Bitcoin tends to follow along. So we've kind of used the roadmap in the stock market to help forecast movements in Bitcoin also, since they tend to be positively correlated. And so my point being is that that Bitcoin is just another speculation, just like stocks are.
All of which relates to the fifth wave nature of where we are, because in our view, Bitcoin is almost entirely a speculative instrument. It's been rising this whole time, and since that's on log scale, you can't see kind of the excitation that it demonstrates with those blasts higher into each of those peaks is a thrilling experience. But we think in the long run, it's part of a process through which we transition from a bull to a bear market.
Interesting.
Yeah. Andy, we've talked about it a lot on the show, haven't we? I mean, this is all the Bitcoin phenomenon is just driven by the destruction of wealth, the destruction of the middle class, the despondency that young people have because the monetary system benefits those closest to the money supply. Those furthest away are feeling their purchasing power destroyed. They can't afford to buy houses anymore. And so they're desperate for a get rich quick scheme, aren't they?
That's absolutely. It's the gambling mentality. And that's the interesting thing, that gold is up 30% this year, and it's completely and totally ignored. It's outpaced the S&P. It's averaged 9.9% per year for the past 25 years. It's completely and totally ignored. It's the tortoise, not the hare. And so, my mentor way back when, Richard Russell, used to say, you make 7% plus a year, you're a rock star. And here we have what I consider to be one of the most conservative things on the planet that pays nothing in the way of a coupon or a yield, yet it's outpaced the S&P 500 for 25 years with dividends reinvested. So yeah, I think there is a lot to say about the potential setup for this to drag a lot of people down. And when you think about the amount of cash that's been on the sidelines, over $7 trillion in money markets, as we get to the end of this fifth wave, in risk on speculation, it really could be a disastrous type of pullback. And I don't discount one thing these guys are saying. I came into this market in 1989 as 19 years old, and that was 2 years after Robert Prechter became very famous for calling the market top in 87. He called the crash, and I remember it vividly. He was a rock star in the industry. This is before the internet, when people actually read newsletters. And so when you talk about its predictive feature, I'm very, or its predictive capabilities, I'm very intrigued. And then you add into it the supercharging of all of this money that's been created, that's sitting on the sidelines in money markets, this speculative rush into equities. These guys are saying in the fifth wave, how much runway is left on the fifth wave and what does it look like when it turns? And then you see this spillover into risk off, like precious metals. And so maybe you guys could explain what that rush would look like and how that would set up, or what you're seeing right now in gold and silver in terms of where you see this going a year or two out.
Yeah, going forward, gold has got a lot of potential, and some of what you say is like outside our purview. It's like the intermarket relationship. What happened last year, 2023? Gold is nowhere. Some people like gold all the time, and so they're bullish. But if you take them away, who's left to have kind of discerned that gold was turning, and what was their basis for doing so? I'd like to know.
It's the central banks. They've been buying more over the past 2 years than at any time in central bank history. So it's the most well-informed traders in the world are buying it hand over fist. That's who's been really driving the price higher.
We go back to July of 1999. That's a very important date in our mind, because that's when the Dow divided by gold, real money, peaked. People don't realize that, but the market has been in a bear market since 1999 when you value it in terms of real money. It's just that stocks, the S&P is up 6 times since 1999, but gold is up 10 times. It's outperformed that. What's happened basically is we've had a destruction in the unit of accounting, which is the US dollar. So it appears that the market has just been floating higher and we're in this huge long-term bull market, but it's because we've had a diminution of the unit that we accounted in, which is the dollar going down. Now, in terms of gold, I think it's in a bull market. The bull market's not complete. Last year, we recognized, it was in a sideways move from 2020 for a couple of years, gold was, and then we kind of recognized what was happening within the pattern. It was like a eureka moment for us, because we said, okay, this is where we are and this is what it implies. And we got particularly bullish when we saw the end of a pullback in October of 2023. Gold was about $1,800. Spot price is $1,810. We recognized the end of the pattern there, and we said, okay, we're going into a third wave here, which is going to bring us to new all-time highs. We're going to rally very strongly. And our forecast with respect to gold really doesn't look at central bank buying or selling or anything like that. We're just looking at the waves, and the waves are telling us that we're going higher. Now, we're in a short-term correction. We've completed this third wave. We're in this fourth wave correction. It might take a little bit of time, but that's okay. We're patient, because we know that when this fourth wave is over, we're going to have this big fifth wave in gold where it's going to rally to new all-time highs. And I think that's really when silver is going to get exciting, because silver is one of the most under-owned precious metal or asset relative to all the other assets, and particularly relative to gold. I think silver is going to start spiking at that point. So we're coming into that process. We're not there just yet. We have to have some patience. But when it hits, I think that's when gold and silver are going to really start taking off again to the upside.
There's been a 90% correlation in gold and silver in their movements since the beginning of time, not always symmetrically. So does that mean that you think that silver is lagging gold in terms of its wave principle also? So in other words, are we in the third wave in silver and not in the fourth wave like we are in gold, or are they still aligned?
No, they're still aligned. Their patterns can misalign or do different things at different times. but I do think they're still aligned. And I think the big move in silver is going to be as it gets moving relative to gold going into next year, 2025, maybe a little bit later in the year. But one of the things you have to realize in metals, and particularly in commodities, but metals too, is that fifth waves tend to be the extended wave, the wave where you get that blow off move to the upside. Blow offs are very rare in stocks because the motion's a little bit different, but blow offs are often common in commodities and precious metals because the emotion that's driving that fifth wave is an emotion of fear, which is a sharper emotion than some of the other emotions. So I think the biggest moves yet to come probably are going to be in silver relative to gold, but gold and silver together are going to go higher.
Well, it's a good job we launched silver on Glint last week, isn't it?
Yes, it is. Long overdue. I'm glad it was done. I think it'll be a home run.
So guys, it's been great talking to you. Now tell us, how can our listeners actually engage with you? What products do you have to engage with them on? What kind of community can they engage with you on?
Well, we're actually running a special right now for people watching. If they go to www.elliotwave.com, there's 2 L's and 2 T's in Elliot, elliotwave.com/Glint. And for $11, they can purchase the Elliott Wave Theorist, which is written and edited by Bob Prechter. They can purchase the Elliott Wave Financial Forecast, which Pete and I write every month that comes out. And they get the short-term update, which I write every Monday, Wednesday, and Friday after the market closes, kind of as an update between each issue. So you get the Elliott Wave Theorist, the Elliott Wave Financial Forecast, and the short-term update, $11 for a month. And that's usually costs $97. So we're pretty excited to offer that for people who are interested in finding out what we do, maybe giving us a kick in the tires and a ride and see whether it makes sense for them.
Wow. So that's $97 worth of product for only $11. That's $11 a month. Is that right?
Yes. Yeah.
Instead of $97 a month.
I'm going to take advantage of that myself.
Yeah, I'm going to do the same thing. This is like better than a Black Friday. This is a Golden Tuesday offer, I think.
If you go to the website, there's lots of books and resources. And Andy was asking, well, what's the main one? And that would be the Elliott Wave Principle, which unlocks the wave principle in its entirety. And it's not even that big of a book. So it's all there in black and white. And if you study it and come to know it and apply it, you'd be surprised. It's fun, interesting, and profitable.
Sounds good.
Amazing. Well, we'll have the links down in the description below. Any closing thoughts? Any things you just want to say before we finish?
Oh, I just say thank you for having us and for putting out your product. I think it's something that makes sense and is going to have a good future.
Yeah,
Andy?
definitely. I downloaded your app the other day after we talked and gave it a spin, and very interesting product. And I'm looking forward to delving into it a little bit more.
Cool. And of course, when our clients need the physical metal in their hands, of course, we've got Andy as well, the bullion baron, there ready to make sure that's dealt with. Andy, have you got any other thoughts before we leave?
No, just fascinating information, guys. I think record proves it. A lot to be said about its predictive qualities or features or functions, but I'm intrigued. I've always fancied myself in understanding the general principles, but I think I'm going to dig a little bit more into it and take advantage of this amazing offer. I appreciate you guys coming on with us.
Yeah, well, listen, as when you go hiking in the out in the wild, you got to be resilient. We call this a resilient compass because we're here to give you the tools and some of the perspectives to help you, guide yourself through the challenges that we've got ahead. As the everyday person here, we're striving against all the challenges that are thrown us at all the time. And I think this is another compass. This is another tool that we have in our backpack to help us get through the challenges. So guys, thank you so much for coming on. I really appreciate your time. And remember everybody to check out the offer below. Go and check it out. $11 a month. That's fantastic for the knowledge and the protection that we're going to be able to have as we move forward. So thank you very much. And remember, subscribe if you want more. Make sure you're up to date with any of the latest episodes that we're bringing out. Sometimes they don't quite all drop on a Thursday. We've got some other great episodes which will be coming live in the next few days, and we'll continue to bring some interesting guests and some interesting information to you. Remember, we're not offering financial advice here, just information for you to consider. You must always take good financial advice from your advisors if you're going to, when it comes to running your money. But I think fantastic information that we've had today from Stephen and Peter.
Absolutely.
Until next week, see you later.
Bye, guys.
See ya.
See ya.
Thanks for having us. Bye-bye.